This very tight range, right? Between 17,800 to 18,300. There seems to be no major cue which could take the market out of that range. And we have Prateek Agrawal joining us in this studio as well. Prateek, thank you so much for being with us on the show. Great to have you here. Prashant very helpfully put up all the stats for us. Do you think there's anything in these cues that could take the market out of the range?
No, so beginning of the year when we looked at the market, we thought, on 1,000 ballpark 25 earnings, we should be 18.5 times. So 18.5 is the range that one should expect the market to be for this quarter, which will actually sort a lot of the issues that we may discuss going forward. But definitely, think of this period as a period of consolidation. Maybe debt looks a tad better than equity, and hence I say 1 quarter of consolidation smoothens things well for equities. Now, in terms of what Prashant was saying, this quarter and maybe few more going forward is not about sales growth and sales growth led earnings growth. It is about margin increases. And margin increases will be seen more in manufacturing versus in banks versus in IT, etc. IT also will see some margin increase, but more in manufacturing, which is where I think some positive surprises would come.
Okay.
Sonia, so while you spoke about the markets being flagged, Nifty, Sensex, but for me the big takeaway was the fact that the FI selling has abated. Just 400 crores of FI selling this week. When have we seen the last, just 400 crores of selling from the FIs? Two reasons for that. One, last week, when I gave that update of big FI selling, it was largely because of one of the long-only FI was unwinding the India position. So that's largely done with. And to that, there was an ETF buying as well whole of this week. So that's actually, helped the FI number to a larger extent. So that's a big takeaway as far as the deal rooms are concerned. The other important thing is, while earnings are mixed, Prashant spoke about it, but the big trigger for the from next week onwards will be that we are moving to T+1 settlement. All the large cap names, the blue chip stocks will shift to T+1. That would mean that the liquidity will improve. And I guess this is like a kind of an historic moment as far as India is concerned. So that's something to track. But largely, the big takeaway was the earnings are mixed. The Nifty has been flat, indices have been flat. But the fact that the FI selling has abated a lot, that's a bit of a positive sign as far as markets are concerned.
Okay, let me take that forward and talk a little bit about what happened this week. And we got a flurry of mid-cap IT names, right? The previous week was all about the large-cap IT names, but this week we had numbers coming in from Persistent, L&T Tech, Coforge, Cyient, Happiest Minds, so many of the smaller ones also reporting. The key takeaway is that the mid-cap IT performance was very divergent. The large-cap IT performance was consistent. HCL, TCS, Infi, all met expectations, did better. But in the case of IT earnings this time, Persistent, Coforge looked better than what the street was anticipating. And on the flip side, you had Emphasis and L&T disappointing. So the key takeaway is that the mid-cap IT performance is far more diverse. To elaborate on that point, L&T Tech downgraded its revenue guidance, but on the flip side, you had Coforge upgrading its guidance. So that's point number one. Unlike large caps, where the performance was consistent, mid-cap performance was far more divergent. The next point is, despite all the noise about macro uncertainties, slowing down on deal wins, slow decision making, the deal wins this time have been very strong, even for the companies which have missed expectations. Take a look at Emphasis. Emphasis was a miss in Q3 numbers. It was impacted by their mortgage business, but Emphasis' new deal wins were the second highest on record. Coforge reported its highest ever order intake in the current quarter. Now, the point is that typically when this situation, when the external environment is far more uncertain, it's the large caps which generally have a steadier performance compared to the mid caps. And the reason is mid caps have a greater client concentration, a geographical concentration, or a vertical concentration. So if any of the drivers hit or if any of the legs misfire, then the stocks get impacted. In the case of Emphasis, for instance, they have a near 8-9% exposure to the mortgage business, right? Now that entire leg is not firing. In fact, it's declining for them. It saw a sequential decline of 20%. And that's the risk when it comes to mid-cap IT because they have a far higher concentration, either in top clients or in terms of specific verticals, unlike large caps, which have a more diversified base in terms of clients, geography, and even the kind of services that they offer. And that helps them tide through any kind of volatility in the macro environment. And one more final point, we were talking about valuations in mid-cap IT. Take a look at Persistent. Persistent is one of the most expensive mid-cap IT companies. Yet, on the back of good numbers, the street rewarded it. Persistent ends up with a gain of close to about 8% despite it being very expensive. So that's telling, right? That there is interest in IT, despite the high valuations for some of them. If the companies can give you the confidence that they can tide over this rough patch.
Let's ask the man next to you what he makes of IT. Prateek, any interest?
Actually, yes. So we at the house continue to be underweight IT, but versus the earlier level of underweight, we are now getting closer to where the index is, though still underweight. Now the point is, while there is uncertainty in the external environment, we have seen sharp cracks. And well, the whole debate is whether after the fall, post-COVID, will the growth rates fall back to pre-COVID levels? If they do, then the valuations are still higher. But if they sustain a tad higher, which is possible, then I think valuations are very sustainable. So we are nibbling there for sure. I take the point, the larger cap IT companies are steadier. But then, larger cap IT companies are more order book driven. So more long period orders driven, less of shorter period orders. So the volatility in the smaller cap is also because they are shorter period order driven, which tend to be volatile. So and of course vertical. So if there are spaces which are doing well, open up trade.
Like mortgages, like we mentioned. I mean, that's
You've got to be selective when it comes to mid-caps. Very selective mid-cap IT.
Okay, all right. Well, the other big event, of course, is the budget that's right around the corner. Generally, it's a financial statement. We don't expect too many, developments on the budget day itself. But let's just put together a quick snapshot of what to expect. And then I want to toss the question to you, Prateek. Now, there are a couple of things. One, there's an extension of the corporate tax rebates for green manufacturing. And we do know that in this whole green manufacturing renewable space, Reliance has a huge investment that they've made, 75,000 crores. There are EV manufacturers as well, like Tata Motors, TVS, that could be in focus. Apart from that, everyone's expecting this to be an infra-heavy and capex-heavy budget. There's an expectation of a 15% rise in the budget spends on roads and railways. You've seen stocks like L&T at a fresh 52-week high as well, so that will be on our radar as well. Now, there could be a significant 20% boost to rural infra schemes. So this could be either housing for all or village roads, etc. This is in general positive for cement as well as for rural spending. And we have seen how up until now, a lot of the capex has been government driven. Now, the government is looking to broaden that to private-led capex as well. So, cement, metals, etc. could be in focus. Apart from that, rural spending schemes, NREGS could be positive for staples. So look out for names like HUL. There is a potential hike in the FPI limit in banks and insurance companies to 100% from 74% earlier. That could be positive for private banks as well as for insurers. So keep that in mind. A couple of other quick things. An insurance amendment bill that may address the composite licenses, the changes to the solvency issue, etc. And that could impact a lot of these insurers, whether it's SBI Life, HDFC Life. Tobacco taxation, we always talk about that. Up to a 5% increase is something that could be good for ITC, because if it's anything more than that, the street could take it negatively. Privatization candidates, names like IDBI Bank, Concor, Shipping Corp, BEML are in focus as well. Now, a point that, of course, is a bit tricky for the market is the indication of any kind of potential change to the capital gains tax regime. Jefferies put out a note where they say that there is a possibility of an increase in equities capital gains tax. There's a possibility of the change in the definition. Of course, it will be negative for the market if it comes through. But Prateek, from all of this that I stated, anything that you think could be market moving, sector or stock-wise?
No, so the budget should be an exercise in continuity. So globally, countries are focusing on building up infrastructure, building up capabilities internally. And I think same will be seen in India. It could be through extension of PLIs, it could be through, some tax benefits extended to one part of the industry and so on. But globally, building up domestic capabilities is the thought which is all pervasive. I don't think any of that surprises the market. I think on capital gains, I would be very hopeful. So equities are treated in a particular manner, debt and unlisted equity in a slightly different manner. I do hope that there will be convergence, towards equity. you know, that is important because, you know,
convergence to debt.
Towards equity, because, you know, globally, you know, long and short-term equity is 1 year.
Yes.
Okay,
Yes.
so if you go beyond that, you are diverging versus the globe. Now,
Yeah.
that has implications on back offices, how people look at you, and so on. And two, this is a period when, you know, we need to put our best foot forward so that world looks as, and we need both debt and equity money is coming in and private equity. So in a period when, you know, central banks are taking out money, M1 is going down, you know, I think you need to just be that much more open and do everything possible to attract money.
You made the point of building capacity, and we're going to focus on building capacity in railways, right?
Yes.
Railway capex is a theme which the market is very excited about.
Prashant.
Tell us more.
Sonia spoke about the key beneficiaries in the budget. Now we don't have a railway budget, right, so to speak, right? So of course there won't be much on the railway budget, but within the budget itself, there is going to be a lot of focus, I believe, on the railway side, and that's what I'm looking to put out a piece this week. So look at the Vande Bharat opportunity. That's going to be a big opportunity. We saw what happened to Siemens last week. That stock was up 10% on the back of a large order. I mean, it's the biggest order that Siemens has bagged in their entire history of 26,000 crores. And not only that, they've also been the L1 bidders for two projects, the Surat and the Ahmedabad Metro project, and of course they are in partnership with RVNL, but they have a 65% stake there. And you know, the order inflow of locomotives is going to be a key driver for Siemens and companies like that going forward. So how big is this opportunity is I'm looking at. So look at the big picture in the Vande Bharat itself. It's a 1.7 trillion opportunity from the recently floated tenders that we've seen. Now the initial tranche of 200 trains is an opportunity of 60,000 crores. That's kind of opportunity we are going to see in the railway. So who are the big beneficiaries of that? I've split into two halves. The first is the preferable players in the tier 1 players. That includes the names like Alstom, Medha, which is an unlisted company, and Siemens India. We already saw a big order for Siemens India. The tier 2 companies which are going to be component suppliers, they're the likes of ABB, CG Power, BHEL, and BEML. These are the few companies which are going to benefit. Now, I have further drilled down to the large, verticals within the Vande Bharat opportunity. The first one is where, that accounts for the lion's share of 45%, which is called propulsion, system. In that, the key beneficiaries are going to be Alstom, Medha, Siemens, BHEL, and CG Power. These are the 5 companies which are likely to benefit. The other big component within the Vande Bharat will be the rolling stock, which probably we call the wagons business. That's going to be another big segment which is going to benefit. And within that, the key players are Alstom, BEML, Titagar Wagon, Jupiter Wagon, and Texmaco. These are the 5 companies which are going to benefit from the rolling stock. So that's the opportunity for those companies. Now, apart from that, the next big trigger will be the another 200 trains of Vande Bharat, which are going to come up in the next few years. So that's going to be a big capex opportunity for all the railway companies. Now, if you look at what the railway minister spoke to CNBC TV18 from Davos, I just quote him: the production of 80,000 wheels is a huge order for the Indian railway industry, and this is the kind of order which will give a visibility for a lot of companies for a very long period of time. So that's the kind of opportunity which the railways are going to throw up. Now, who will benefit? I've just listed out the few names, but I guess while we don't have a railway budget now, but anything to do with the capex, and within that, the railway capex will be very important for the entire sector and for individual companies as well, that I pointed out in that piece.
Okay, Nimesh, thanks a lot for that. Prateek, how are you feeling about this space? Generally, we talk about it once a year. I don't know if it's given great returns to investors in the past. What is the prognosis like? Your thoughts?
No, so engineering is a wider space that we are focused on. It's an overweight position with the house. There are lots happening. So, the whole broad theme is we over time have seen reduction in manufacturing as a percentage of GDP. And through PLIs, through, focus on renewable energies, railways, and the lot, we are seeing a reversal. And this time, happily, it is not like, one sector, two sector led, it is across. So I think engineering companies, the space itself, practically everything should end up benefiting.
Okay.
Prateek, what I'm going to do is I'm going to present this P compression growth stocks that we've seen. I'm going to walk across to the big wall to do that. Actually, this is just presenting data, not very much beyond that, and maybe just leaving you with a question. So what are we doing? So I'm calling it growth stocks or reality check, and I'll explain why. So let's have the graphics up. Okay. So, there are 2 angles to it. One is, of course, the macro angle, and then there is a local angle as well, which I will explain in just a bit from now. Okay, Prateek, we're just having some trouble pulling up the graphics, but you know, that first question that I put out, as part of my sort of discussion, market setup that I put out, these high P multiple growth stocks, in your opinion, is there more downside here?
No, sure. So, you know, if you look at that space, you know, if you pull up the FMCG index, now over 12 years, over 15 years, it's done a 15% CAGR, while the profit CAGR is 12%. You know, and on top of it, give or take a % of dividends. So this space has seen expansion in valuation for a very, very long time. And now what we are experiencing is one more number of new entrants coming into the space. So if you look at, let's say, paint space, somebody coming in. If you look at diagnostics, you know, many more players coming in and so on. So the promise of the space that you don't get new entrants and the market is there for you for taking is now being tested. You know, in a period that this happens, you know, one should expect the market to pause and you know, see it all happen rather than continue to repose faith in the same space. The other way of looking at the whole thing is, you know, if you blow up the value of a particular business, you know, many of these businesses derive a lot of value from the brands, you know, and maybe distribution, but brands is a large part of the value. Now that doesn't get impacted if the, for example, earnings go down because of manufacturing margins, right? So it stayed constant. So in a period when you did not see margins expand, these spaces held out much better. Now, if they derive their profit growth going forward on account of, let's say, commodity price drops and hence margin increases, to believe that the manufacturing margin-led profit should be given the same 60-70 P is probably not right. And hence, I really believe this is a space which should see some amount of valuation correction going forward. And, you know, so I say it differently. I say the highest quality, not so high growth part of the market, you know, this part is consistent but not very high growth part, is probably a part which will neither sustain wealth nor grow it for some time.
Okay, well, that's a fair point. We've actually run out of time, but not out of questions. Prateek, thanks a lot for stopping by and coming to the studio. And to all our viewers, have a great weekend. Next week is going to be a hectic one. We're going to react to a lot of big earnings, Reliance, Kotak, ICICI Bank, and then we head into the big union budget. Keep it with CNBC TV18. Thanks for watching.